Today's morning brief up on the Yahoo Finance homepage discusses how executives are doing a great job of talking down the United States economy. Yet amid the cautious C-suite talk and relatively weak earnings growth, the S&P 500 is up so far in 2023. And Saz is the one who wrote the brief. Luckily, he's sitting right here next to me, so let's talk about it, Saz. It is interesting, the sort of disconnect, right, that we are seeing between the rhetoric and it's not necessarily unusual, but it is interesting.
Well, I was reading this, and I'm like, wow, I really like that. And I'm like, I wrote it. Of course, I really dig it. I will say this. I love the morning brief newsletter every morning. Our team doesn't have to.
No matter who writes it.
No matter who writes it. Especially you, Julie. I love what you when you write it. But look, we've seen a lot of executives here, and the point of this newsletter today is, I think, really trying to get investors to understand what we're hearing from a lot of executives. We talked to XPO CEO last week, voicing, I would say, concern about how things are shaping up for their key month of March in terms of delivery and retailers. We've had Starbucks come out here and warn. We've had other companies come out here and not say good things in terms of not only how the fourth quarter panned out, but really how things started for the first quarter. And then you take that negative commentary, you compare it to an S&P 500 trading at about 18.5 times forward earnings, and that's just something's mismatched here. And at one point, does this market break and start to, price in some of these concerns here by corporate America?
Well, it is pricing it in when it comes to specific stocks, certainly, yes. Right? The companies that are coming out with this negative stuff,
they've been hammered.
They're getting punished, right? So it's not like that investors are overlooking it on a specific stock basis. It's more just overall, we are not seeing that kind of reaction in the market.
Yeah, I think we talked to PepsiCo CFO Hugh Johnson last week too, and I've talked to Hugh probably 7 or 8 years. I've never even heard him say the word recession. And to hear him come on Yahoo Finance and say, my base case is a mild recession this year, that definitely raised red flags. Red flags, but they're seeing strong results. But still, he is looking beyond the first quarter, maybe a seasoned CFO, and telling us growth may slow sharply.
Okay, so a couple of things. Yes, Pepsi is still seeing strong results, but he also made it clear, and I think this is something that companies do, they plan for the worst.
Sure.
That's part of their job. So I think that, you have to sort of take some of the negative commentary with a grain of salt from these corporations. Better for them to guide negatively or pessimistically and beat than the opposite, right? Better for them to plan for the worst and then have things turn out better than the opposite. So I think maybe that's also why investors are sort of focusing on their own scenarios and not necessarily the rhetoric that we're getting perhaps from some of these CEOs.
Yeah, no. Well, let's continue to dive into this. Has the stock market gotten too gymmed up on hopium, like we've been talking about here on Morning Long? Young-Yu Ma is Chief Investment Strategist at BMO Wealth Management. Young-Yu, good to see you as always. Your take on the morning brief. You think the market has just gone too far too fast here?
Well, I do think it's a natural reaction that we're seeing for CEOs to be somewhat cautious here. The market's been very forgiving, but we've had this uncommon or unprecedented boom and bust really at the same time, depending on which sector you're in and where your business is. So I think that the market needs a period of digestion here, especially since we have a bit of a shift in terms of what the expectations are for interest rates and still a very strong labor market and wage gains that have been coming down, but still are a little bit on the high side. So I think all this makes sense, but it's probably an air of cautiousness that CEOs are having right now.
So, Young-Yu, what does that period of digestion look like for the markets? Is it sort of a sideways movement? Is it more volatility? What are you expecting for the next sort of midterm period?
Yeah, I would expect more sideways movement. I think we still have to wait to see how the data comes in. Really, the market for so long, or to start the year, had been keying off the idea that interest rates are actually going to come down toward the end of the year. And now that expectation is removed from the market, I think we just have to see what the data holds for us. Is inflation going to come down the way people expect it to? Is wage growth going to come down? Are there going to be other signs that are concerning the economy? Is the labor market going to be too hot? I think it's really a period of wait and see and digest these gains to see if the same thesis that the market had been really pinning its hopes on to begin the year still plays out in the middle and end of the year.
And where do you stand today on the move in tech stocks? We've seen tech stocks, by and large, not all of them, but a good number of them rise as we've seen the 10-year yield pull back. But some of these tech results have been awful, and now you just continue to get news of layoffs across the board.
Yeah, I think we're neutral on tech stocks overall. I think the news of layoffs in some instances, of course, has been taken positively because a lot of these tech companies really gorged on hiring during the pandemic. So a lot of this we see is rationalization, probably sensible cost cutting, and we see an environment going forward, of course, of one where we're going to see a lot of dispersion among winners and losers. But there has been a big run. Interest rates are probably going to rise a bit on the long end of the curve, and that's going to provide a headwind for tech stocks. So it's not our favorite sector here, but it's one we still think, of course, in the medium term and long term has a lot of growth potential.
And we're looking ahead as we talk about all this inflation talk. We talked about it a moment ago that tomorrow's CPI release is going to be important for the markets. But you point out, as we go forward, maybe there's other stuff that the investors need to be looking at as well. What's in your sort of data suite right now that you're prioritizing?
Yeah, as long as a CPI report doesn't surprise too much either way, it might not be as market moving as it's been in the past few months. I think a lot of what's going to be focused on going forward is wage growth. The Fed is very concerned about the labor market being too tight. And the Fed's concern is really about not just inflation coming down in the near term for the next couple of months, but what's going to happen toward the end of the year and next year. And the Fed wants to see that wage growth is in a comfortable place so that we don't see the type of reacceleration of inflation that might happen or that's happened in the past. So I think there's much more to the data that the Fed's going to be looking at here.
Have you started to bet against the U.S. consumer?
No, I wouldn't bet against U.S. consumer. I actually think we're going to see inflation come down by mid-year and wage growth still stabilize and stay in a healthy level, and that we'll see wage or income gains in real terms adjusted for inflation. And that's going to help to stabilize spending here. I think the consumer overall is going to hold up well, even though there are some clear strains at sort of the lower income spectrum right now.
Young, good to catch up with you. Thank you so much. Chief Investment Strategist at BMO Wealth Management. Appreciate it.